Crypto actually moves very fast, all right, especially crypto, and I'm very sure you guys already know about that. The price changes every second. I'm very sure you guys are very serious about making money in crypto, and you need to understand how to read charts like a pro, because chart speaks a story that no other tools can show you. Hey guys, welcome to another video presented by Bitcoin Hitpoint. My name is Fahad, and let's get started with this video. So let me give you a quick breakdown of what you will be learning in today's video. So first, we'll be covering the introduction to crypto charts and the basics part, which is very obvious. Second would be what are the types of crypto charts. There are different types of patterns, there are different type of candles that you can be following, so I'll help you understand them as well. Third is candlestick patterns. I'm very sure if you're a beginner, you have been hearing a lot about different types of patterns, and I'll help you to reduce those noise for yourself. Next would be what are some of the key indicators in the market which you can be using for your analysis and trading purposes. Next is time frames in trading. So there are various time frames, 5 minutes, 10 minutes, 15 minutes, and I'll help you understand what are the significance of these different time frames in trading. And last, it would be what are some of the most common chart patterns. So first let me guide you why reading charts actually matters. Like why can't you just see some random data, or why can't you just trade on the basis of your feelings? Crypto actually moves very fast, all right, especially crypto, and I'm very sure you guys already know about that. The price changes every second. Literally the moves which you can say in Bitcoin or literally in any other crypto coins are massive, right? So it's very important to understand where the charts will reverse, where the price will reverse from, what's the market behavior, and what are the opportunities, like which most of the trader actually miss, right? So moving ahead in this video, let's first try to understand how can you understand where the chart reveals price trends and market behavior, right? So first let's see what is a point of reversal. So I'm very sure you guys must have took a lot of trades by now, even if you are a beginner, and most of them would have either got stopped out or liquidated. So let's say if you had a good knowledge of market, if you had a good knowledge of price action, and you were able to understand what could be a point of reversal, just like we see something like here. If you could have witnessed this on your chart, if you had a good knowledge about price action, that is definitely what you would have seen on your chart, and you could have took a trade right at this level, and then you could have just ride with the market to the upside, right? So that is very much possible. But to make that possible, you need to understand how price action works, how a chart develops. So that is what we'll be understanding as well. Next is how to understand what is a trending market. Now, each and every point that I am discussing about reversals, about trending market, we will be learning about that. We are also someone who is making sure that we are live streaming daily. So we are live streaming daily at 10 p.m. So if you guys are interested in learning live as well, just make sure you have subscribed to the channel so that you can get notifications every time we are live as well. All right. So understanding where a trending market is, because once you can understand if a market is trending in a particular direction, it helps you a lot to take trades in favor of the trend, and most of the trades which are taken in the favor of trend will definitely work out, right? Like most of the trades. Also, if you understand how to read chart, it actually helps in making informed trading decisions, and this is something which is very very important, to make decisions which have certain data behind them, which have certain logic behind them, rather than just taking trades based upon emotions, right? And that is the very next point. If you know how to read chart, it reduces your emotional trading by relying on data rather than what your instinct says. These are some of the most common mistakes that we have been doing in trading. I'm very sure there is at least one of them listed on this image. You are either getting into fear mode, or you are getting into greed, anxiety, FOMO, doubt, nervousness, or overconfidence. Let's say if we took three trade and all the three trade were in profit, now that gives us a confidence which is not actually confidence but overconfidence. In the very next trade, we'll be taking trades which are with extremely high quantity, high leverage, and whatnot. And that is what we are not supposed to do. We are supposed to stay in control. We are supposed to make decisions which are logical rather than just being emotionally driven. Also, since we are discussing about how to read chart patterns or charts, there are also different types of crypto charts. And these are not just specific to crypto. You can be using them in literally any market that you trade, be it Forex, be it crypto, be it stock market. Literally every market have this crypto chart types, which I'll be just discussing with you guys. And it actually helps a lot. They serve a different purpose, and you can just make sure whichever fits you the best, you can go with it. The first is line chart. So it's very simple, it's very clear. It just shows you what it makes it very clear to understand what the trend of the market is. It reduces a lot of noise. And if to give you an example, this is what a line chart would look like. It is literally just lines forming on your chart. There is nothing else, no candle, no bodies forming, nothing, no wicks. There's nothing like that. So it just removes all the noise from your chart, and you are just watching a line and making decisions based upon that. Now, obviously, you need to master it because there are always pros and cons of every chart pattern. So, this is what a line chart looks like, right? Next is bar charts. Now, this is a bit different from our normal candle types. It doesn't have any sort of body. It does have some part of it, but not everything. If I just give you an example, this is what it looks like. So, if there's going to be a red candle, so it opens at a certain point. Obviously, if it makes a high, that's something else. This is what a wick would look like. And then if your body closes below the open point, this is how a red candle is formed, and that's the low, that's the wick, right? So this is what this pattern would actually look like. It doesn't have any sort of body, so that's the only difference which you cannot see here. And then the exactly opposite for a green candle, it opens at the bottom, price moves towards the upside and closes above the open level, and that's why it closes green. And I'm very sure you understand why a candle closes into red or into green. And obviously you have options as well that you can change the colors. I have changed the colors for myself, but that's subjective. If you guys want to change it, you can change it. I do not keep a red candle on my charts. Next is candlestick chart, and this is literally the most popular chart pattern. I'm very sure each and every one of us, most of us, are following this very chart, which is candlestick. So this is what it actually looks like. It has a body, just like the previous pattern which I just showed to you guys. This have body as well. So in the previous chart pattern we didn't have this body. It just had a opening, a high, and then closing if it's a red one. This is what it actually looked like. That's it. It didn't have any sort of body, and that's the only difference which this chart pattern has from the previous one. Now let's try to understand some of the candlestick patterns that we can be using on the very daily basis. But before that, I've just given you a quick breakdown of why a candle closes green or why does it close red, right? So that's done. Now these are some of the most common patterns that you can be watching on your charts. I'm very sure this will confuse you a lot. You'll be it seems very complicated. So I'll just short them down for you. Some of the most common patterns, I'll make sure I discuss them and also give you example of one of those patterns at least. But this is what a spinning top would look like. This is what a shooting star would look like. Now this is a bearish confirmation. This is a bearish candle. So if you see a shooting star, all right, if you see a shooting star forming on your resistance zone, this can be one of the keys to get into a trade, all right. And then there's a hammer, almost like opposite of a shooting star. If you see it's forming on your support zone, you can look for a buying opportunity, and that is how these patterns are supposed to work. Then there's the doji. This is an basically an indecisive candle. You cannot make any decision based upon doji. What you can be doing is you can wait for either the lows to be get taken out or the highs to get taken out, and then probably you can take a direction if it is following the trend. Next is bullish engulfing. So when a candle, right, like you formed a red candle, and then a very next candle is green, and it like basically covers the whole previous candle. That is what a bullish engulfing means. And similar is the case with bearish engulfing as well. Like this candle is overshadowed by this one. So that is what a bearish engulfing means. Now there's an evening star pattern. This is a bearish pattern. So if this is forming on your resistance zone, that could be a trigger for you to get into selling or shorting the market. All right. And then there's morning star, which is exactly the opposite of evening star. If they are forming on your support zone, you can look for some buying opportunities. Now, three soldiers, they show strength in the market, and then there's three crows, which shows weakness in the market. All right. So this was a lot of noise. I would say I following all the patterns will only make your trading very, very difficult. So make sure you are only following one or two or max to max three patterns only. Now, if I had to share with you guys some of the most common patterns that you can be seeing in the market are basically a doji or hammer or shooting star. But again, I just explained it to you guys earlier how a bullish candle is formed or how a bearish candle is formed. So when price opens at a certain level and drops down, all right, let's say price open at $5, this is at $5, and then it just goes down to, let's say, $3. So when this candle is formed, this is basically a red candle. That's how a red candle is formed. So if it's opening at a higher price and closing at a lower price, that is when it is a red candle. But let's say if a candle opens at $3 and then moves all the way up till $5, in this scenario it's going to be a green candle. That's how a green candle is formed, and that's how a red candle is formed. This is how a green and red candle looks like. I just gave you the example as well. So it opens at a certain level when the price moves above. Let's say it opened at $3 and then moved all the way up till $5. This is why this candle looks green. Now it might have moved all the way till $9, but the closing was right at 5. So this is what you call as wick, wick, wick. This is what you call as body. All right. So wicks can be big, wicks can be small. It shows strength and weakness definitely. But body of the candle is what matters the most. All right. So closing of a candle is very key to get into a trade. So if you're a beginner trade, never enter into a trade. If your candle has still not closed, wait for it to close and then get into the trade. If it gives you the confirmation that you wanted. So as I earlier mentioned, these are some of the most common patterns which are doji, hammer, and shooting star. And if I had to give you an example of doji, doji is an indecisive candle, all right? So just like how any green candle or red candle is formed, dojis are formed the same way. Like it opens, let's say we are going to see a green doji, so it will open at $3 or $2 or whatever price and then move to a higher price, but it's not a very significant move. The wicks might be bigger, but the body is very, very small. And that's the reason why it doesn't show any strength or weakness, because there are both buyers and sellers in this very candle. And the same is the case with the red one as well. Like it opens at a higher price and moves to a lower price. That's why it is closing red. But then again, due to the wicks being so high, you cannot identify if the buyers are in control or if the sellers are in control. Now let's try to understand some of the key chart indicators. How can you read chart and what are the most important things that you need to have on your chart? All right. So the very first thing that I would say, and the most important thing, there's nothing important than this according to me, and that is marking support and resistance, because these are the levels where you will be trading. Now these levels can be marked on the basis of data or on the basis of basic observation. Like you can look at the chart and find out that price has reversed from this particular price quite a lot time. So you can just note down that level, mark them as a support or resistance, and look for certain trades there. This is what a good support and resistance level would look like. Like you got a rejection for the very first time, then second time as well, third time as well, fourth time you got to see certain reaction, and then on the very support level you were able to see first reaction, second reaction, and third reaction as well. Now these levels are so strong that you can be seeing some really big moves on them, and this is where you will be basically getting into a trade. So you will be shorting here and you will be buying here. So you need to be very confident with your levels. You need to mark levels which have certain data. Now data levels means either they are, for example, data bag level means weekly open, weekly close, daily open, daily close, or even such other kind of levels. All right, there are a lot of different levels which have different data behind them, and these were just some of the examples that I made sure I share with you guys. Next is one of the most important indicators that I would say that you guys can be using in your trading, which is called as VWAP. The full form of VWAP is obviously volume weighted average price. Now, what does this mean? How does this work? Let me just give you an example of that. So this blue line that you see is what VWAP actually looks like. So this is just like any moving average that you would have been using on your charts. I would say VWAP is far better than moving average, but that That's just an personal observation. You guys can be using moving average if you're fine with that. So now VWAP is basically a line that works on the basis of volume that is entering into a market. All right. So market moves on the basis of volume, liquidity, and key levels. So we have been learning right on our live streams how to mark some really important levels. We have been learning how to understand where the liquidity is. And then again, volume is one of the most important factor in trading because volume is what actually moves the price to the downside. And if it reverses, then towards the upside as well. So it's very important to understand where the volume is entering and where it is exiting. And that is where VWAP helps you. VWAP can play a role of support and resistance as well. So you've got some pretty good shorting opportunities in a downtrend market. You can literally be shorting every time you hit VWAP and look for some great trades. The next indicator, which I would say is very popular as of now, is RSI. All right, it measures where is a overbought or oversold levels, and if you are able to use it accurately, I would say RSI works great for swing tradings and investment opportunities as well because it can show you where there is a overbought scenario or a oversold scenario, and then you can be looking for some buying and selling opportunities as well. So if I had to show you how a RSI looks like, this is what a RSI actually looks like. And if the price moves above 70, that is where your overbought zone is. And if it moves below the 30 level, that is where the oversold level is. All right. So if once it crosses this level, this is where you are supposed to short, all right, or sell. And if you would have sold here, you would have been in pretty good profit. Like you would have been shorting Bitcoin at somewhere around 106K and the price was all the way down till 104K. So you see how good this level works, right? How this analysis works. But it's very important to understand the fundamentals behind them and then use them. And similar is the case as soon as the price moves below this 30 is a trigger for you. If the price is at one of your important support levels, price reaches there and you see that RSI is below 30 points, you can be looking for a buying opportunity or a long opportunity at your level. Always make sure that you are trading on your levels only, no matter how strong the confirmations are at your indicators. Trading is supposed to be done on your levels only. Next is the importance of time frames. I think understanding how time frames can help you in your trading is very important. And why is that? Because the bigger time frames help you to understand where the market might move, but then the short term, all right, the smaller time frames will always help you to get into that particular trade. So let's say if you have done your analysis on a bigger time frame, let's say 4 hours or even higher, all right, so if you have done your analysis on a daily time frame or 4-hour time frame, you'll always have to wait for a shorter time frame confirmation because entering on a 4 hour might be very late entry. It might just move very far away from your support or resistance level, and that is why you are supposed to shift to smaller time frame. So the importance or the significance of short term time frame or smaller time frame is that it helps you to enter into a trade. All right, it's your trigger point, it's your trigger time frame. You can never enter a trade. Basically, if you are leverage trading, if you are going with higher leverage, you cannot be trading on a bigger time frame. You'll always have to stick to smaller time frame for your entries and exits. And then there is a bigger time frame. Now these bigger time frames are used for long term scenarios. If you're planning to invest, if you're planning to get into some really big swing trades, that is when your daily, weekly and monthly time frames will be helping, because they give you a clear indication of the market movement, they give you a clear indication of the trends, and that is how you can enter into a good swing trade or get into a good investment opportunity. Now let's understand some of the most common chart patterns. All right, I'm very sure you have been looking at a lot of patterns: bull flag, bear flag, triangles and whatnot. So I'll just take few of them and help you guys to understand in as simple language as possible, right? So the very first is the triangle pattern. Now these patterns can be ascending, they can be descending. All right. So if a pattern is forming something like this is what you call as your ascending triangle. So this is how your price is moving. And then similarly, if you can mark a price action like this, like let's say your price is moving something like this is called as descending triangles. All right. So now these are some of the types of triangle. There are symmetrical triangles as well, which are not ascending neither descending, so they are basically in a sideways market. So the logic behind these triangle patterns are that the market makers are basically trapping all the retail traders and squeezing them out in a very tight space. And once all the retailers get exhausted, the market makers will move the price in a particular direction in a very aggressive way. All right, so that is how the triangle patterns work. Now, if I had to give you an example, just as I gave you a breakdown of what ascending or a descending or symmetrical triangle would look like, this is what a ascending triangle looks like. Usually, they give you a breakout towards the upside. Now, chart patterns do not mean 100% accuracy. You'll obviously need to have certain kind of confirmations. So you can be switching to smaller time frames, as I just explained to you guys earlier. You can switch to smaller time frame and then look for some key confirmation to either long or short the market. All right, so ascending triangles have higher probability of giving you a move towards the upside. Then there are descending triangle. Once they break the support zone, they have higher chances of giving you a breakdown, and you will be getting a move towards the downside. All right, and then there are symmetrical triangles which doesn't have higher probability in a particular direction. They can give you a move towards the upside as well as to the downside as well. So you'll have to make sure that you are looking for some key confirmations and do not get trapped in fake outs. Now, the next pattern that is very common is double top and double bottoms, because this is how you can understand where the trend might reverse from. So, right in the beginning of this video, I gave you guys an example of what a reversal looks like. And now I'm giving you one of the patterns. Using one of these patterns, you can understand where the price might reverse from. So this is what a double bottom looks like, right? You got your first bottom and then you got your second bottom, and then the price has literally reversed from that very level. The most important part, which I would say, and this is not very beginner specific, but if you get your first bottom and then when you see the second bottom taking out the lows of the first one, this is a higher probability scenario. This have higher chances that it is going to be a reversal point. All right, so this is what you can make sure, so that you do not get trapped in a fake out. It is very important that the first bottom gets taken out by the second bottom, and then the price will reverse in your scenario. And these are some higher probability trades, because most of the time if you see a double bottom, you might get to see a move towards the upside, but then both of them will be taken out and then the price moves in a downtrend. All right, so it's very important to get into high quality trades only. Now this is what a double top would look like. This is your first top and then you have your second top, and even in this scenario if you see, their first top is lower than the second one, and that is why once you took out the first top, it gave you a very interesting move towards the downside. So I'm very sure you are understanding how pattern works, but it's very important to understand what's the logic behind these patterns. All right, so the very logic behind this double tops or double bottoms working out is the liquidity sweep kind of move. Now this is an intermediate to advanced kind of information or trading strategy, which I have been discussing a lot of times on the live streams as well. But then again, I'll make sure we are posting a lot more content for intermediate and advanced traders as well. So thank you guys for joining. Thank you guys for watching the whole video. Make sure you are subscribed to Bitcoin Hit Point so that you can be seeing more such insights. My name is Fahad and thank you for watching this video.